financial services really from a financial point of view. But there were some changes around housing. So say if you were to sell one of your properties, before it was a 28% tax, that's reduced down to 24%. Anyone out there that's got children, if their income was going above 50,000, they would start losing out on the child benefit. There'd be a child benefit charge, but they put that up to 60,000. National insurance. So if you're an employee, that's reducing down from 10 to 8, and for self-employed, that's going down from 8 to 6%, and therefore overall dropping 2%. There's a new British ISA that's coming out. We haven't had much details about that, but it's going to allow you to save an extra 5,000 into an ISA, but it's only going into UK equity, so UK businesses only. And then if anyone, I don't know with anyone here, has to pay VAT, but the threshold is moving up to 90,000. So there's some key points of changes that might impact you on the spring budget. So talking about your tax allowances, the end of tax year is the 5th of April, and each tax year you have different allowances that you can use. If you're a basic rate taxpayer, so earnings under 50,000, that would be that you can earn interest up to £1,000 before you start paying any tax on it. If you're in the higher rate, you can earn up to £500 without paying any tax. And then anything, if you're sitting in the additional rates, your earnings are 125 plus, then you don't get any allowance. That would be key at the moment because interest rates are higher, so you can get more for your money in savings. So just to be mindful of that allowance for this tax year. You can also put up 60,000 into a pension now. That has increased from 40,000. There is some caveats when your earnings go over a certain threshold, and also you can't put in more than what you've earned. So say if you earned 30,000, you could only put in 30. You couldn't then put in 60,000. So your earnings would need to be over 60,000. You've got your ISA allowance, which is 20,000. So that's either stocks and shares, cash, ISAs as well, but that's per person, per individual, and you get that each tax year. If you don't use your ISA allowance up in a tax year, you can't carry it forward. However, with a pension, you can go back 3 years and carry that allowance forward. You can also earn up to £1,000 of dividends tax-free. So that was 2,000, and again, it's dropping, I think, to 500 next tax year. But this tax year, you can take out £1,000 in dividends, whether that's from your business or investments, without paying any tax. And then capital gains. So if you've got any assets that you're looking to sell or investments that increased in value, then you've got a capital gains tax allowance of 6,000 this tax year. So this just mentions again the allowances in more detail. So to be mindful, you've got your ISA allowance, you've got your interest on personal savings, and you've got your dividend allowance, how much you can put into a pension. You've got your capital gains tax allowance, and then also on the inheritance tax side, there's also the residence nil rate band, which is if you're passing your property on directly to your children, that you qualify for that. So just out of interest, we had a look at back in 2022 of how much people used up of their ISA allowance, and we found that the average person in a junior ISA put 913. You can actually put 9,000 per tax year into a junior ISA, so that's for your children. Stocks and shares, again, you could put 20,000 in. The average was 4,568, and a cash ISA, again, you could put 20,000 into a cash ISA. And that was the maximum people put in was 9,432. So people aren't fully using up their ISA wrappers that are available to them. And this is the figures that came back in 2022. So a question I often get asked by clients is, should I be a sole trader or should I be running a limited company? I was a sole trader for at least, I think, 10 years before I made the change into limited company. And making that decision, it's always important to check that with your accountant if you have one. The old rules were if you're getting profit, so I'd say profit is once you've taken off all your expenditure, is maybe more than 50,000, then you should be considering going limited. When you have got a limited company, you can offset your financial planning expenses through the limited company. So you could use your limited company to pay for your protection. You could use your limited company to pay into your pension. You can also do investments while they're within the limited company. So it's a good vehicle for doing your financial planning when you do take that step into having a limited company. If your profits are lower than 50,000, then because of the tax you're paying, it's probably not worth making that move. But I'd say in doubt, check with your accountant. And then just to be mindful that if you did run a limited company, it's likely that it will be additional charges for owning a bank account in a business name, and other things like your accountancy costs might be more expensive because they have to file accounts and so forth. So there would be additional costs for running a limited company as opposed to if you were just sole trader. So the business tax allowances to consider, there's a number of different allowances. So you can deduct business expenses. You've got R&D tax credits. So if you're doing anything that's unusual, you can claim back on that. You've got gift aid, so that's given to charities. You've got business rates relief if you've got commercial premises. There's also corporation tax relief when you're paying into a pension. There's reclaiming VAT and employment allowances as well. So coming on to personal protection. Now that you're self-employed, have you thought about what would happen if you were ill? So what we look to set up is private income protection, and also look at private medical insurance if that's relevant. So say if you didn't have any kind of protection in place, the statutory sick pay at the moment is £109.40, and you get paid that for 28 weeks. That is increasing on the 6th of April to £116.75, but you've really got to think, could you survive on that? And that's what you would get from the government if you were to claim sick pay. So often people have their own private policies in place just to kick in if they were to become unwell. So what would that look like? So say if you had a policy that was paying out £1,000 a month and it kicked in after the first 3 months, and that carried on paying all the way through to you were 65, so not 28 weeks. If you were, say, for example, 45 years old, that would cost you £37.02. So it's probably not as expensive as you might think. We also have options for budget income protection, which is slightly lower in cost because it pays out for a period of 2 years and then you can reclaim many times. But this would be full income protection. So your income is covered then all the way through to retirement. So we have different variations of how we can quote for income protection, say if you were on a budget, but it's definitely worth considering because of how much you would get if you didn't have any kind of protection in place. And we do insure a lot of things. So we insure our cars, our homes, but a lot of times people don't think to insure their income. And especially if you're self-employed, then if you were working for a company, they would give you some element of sick pay. Whereas when you're working out there on your own, it's down to you to make sure that you've set that up. So there's other types of protection out there. So there's life cover and critical illness. So now that you're self-employed, have you thought about life cover? How extensive is a policy that you've got set up already? So life cover would be a lump sum that would be payable on death. Critical illness would be a lump sum that would be payable on diagnosis of a critical illness. Now, say if you didn't have any protection in place, there is what they call bereavement allowance, which is what the government offer you. So they pay you out of a lump sum to start with. So depending if you're in receipt of child benefit, then you'd get 3,500. But if you're not, you get 2,500. And then they pay you a monthly payment after that for a period of up to 18 months. So that's kind of what the government would give you for bereavement. But say if you had your own policy in place, that would pay out a lump sum, which can be used for your children, or it could be used to clear any mortgage liability. And so the reason for having life cover is to cover your debts, or if anyone would be affected financially if something happened to you. So over 40% of households with a mortgage don't actually have life assurance. I've seen it where clients have come to me before and they've not had life cover, so their husband's died. They need to pay the mortgage and they nearly lost their house. And also 1 in 3 people in the UK only has life assurance. There's not a lot of people that have it, but it's a very important insurance, especially if you have any mortgage debt. So say if you were looking for a lump sum that paid out 250,000, for example, and you were 45 years old, the cost of that cover, which would cover you up until the age of 67, would be £28.23. So it's not really as expensive as you might think. And also, if anyone has got underlying health conditions, there is now specialist providers that look to cover you as well. So it's always worth checking whether you can get the insurance. If you're worried about, for example, you might have had cancer in the past, or you might be overweight. There is always going to be options out there for you now. There's more providers available that can offer life insurance in those circumstances. So looking at business protection, a couple of questions to ask really is that, does the business rely on you solely, or is there more key people within your business? Could the business continue to function without those people in the business? When you're running a company, is there more than one shareholder? What would happen if a shareholder passed away? And how would the business be impacted by death or absence of the owner? So there's sorts of questions you need to be asking. If you're your one-man band sole traders, then really you're the key person that needs to be insured. So there's some examples of business protection in here. So protecting the key people. So that would be if someone in your business is key to your business running, to make sure you've got those covered. So you can cover them if they're a key person in that business. They would pay out an amount to the business to allow you to recruit maybe someone new, pay off any kind of loans, or pay off any money you needed to that employee that was ill. If you do have loans and debts within the business, then again, it's important that you have those covered. I won't touch much on shareholders. I don't know how many of you do have other shareholders within your business, but also there's protecting your employees. So, for example, you are an employee of your own business if you're running a limited company, so really you should have protection in there. So there's the different types of business protection. So there's relevant life. Now, a relevant life policy is something that is set up through a limited company. It's a lump sum that's paid out on death to your beneficiaries. And what we call it is death in service. So say if you were working for a different company, might have a lump sum paid out to you. Typically, it's 4 times your income. But say if you're looking to set that up for yourself because you're running your own company, say if you were 45 years old, the premium, if you were going to go and take that out personally, would be £28.23. If you run it through the company, effectively that premium, because you can offset it as a business expense, comes down to £21.73. So you can see the difference in cost if you were running it through the business. As I've touched on shareholder and key man protection already, but there is also other insurances to bear in mind. So indemnity, employer liability, but all those sorts of types of different insurances are normally arranged by an insurance broker. So that wouldn't be myself. But all the other insurances I talked about is something that we would look to set up for you if you needed any help with that. So just coming on to retirement planning. So with regards to planning for retirement, you've got to consider things for the future. So there is tax benefits of setting up a pension, and I'll come on to those. But the sorts of things you need to ask yourself: are you going to have enough for holidays, things like moving home, hobbies, when you do come to retire? So you've got to be thinking, am I going to have enough left in the pot to be able to do those things that I want in retirement? Implications of if you didn't have enough of a retirement pot, you could end up outliving your financial resources. So you don't want to be running out of money when you're older. That might result in you having to change your lifestyle. You might not be able to retire when you want to. You might have to carry on working even if you're in ill health because you don't have enough saved for retirement. So what we do is we do a cash flow modelling called Voyant. I talk to a client about when they would like to retire, and then we work out if they could afford to retire then, and then we play around with the retirement age, depending on how much that they have got saved. And it is never too late to start pensions. I've had clients in their 50s come to see me and start pensions at that age. So it's never too late to get started. But I'll show you the difference in if you start later in cost to you. So now that you are self-employed, have you considered having a pension in place? Do you have a pension in place for your employees if you do have employees? It is a requirement now. When you do have your pensions, have you specified who your beneficiary is on those pensions if something were to happen to you, because they can inherit them tax-free? And if you've got multiple pensions from all over the place, would you benefit having them all combined into one pension? We can also help with that consolidation and see if it is the right thing to do. Say if you didn't have any pensions, and again, you were just relying on the state. At the moment, you would get an income of £203.85 a week. So that would be the only thing that you would be able to live off if you didn't have any of your own private pensions. But you only qualify for that if you've contributed your national insurance for 35 years. So often I get clients come to see me where they might have had natural breaks, where they have had children or through ill health. And we always get them just to check on the government website if they're going to be any years short to get full state pension. So I've put the link in there where you can check your state pension and see how far you are off of having your full 35 years. And if it's getting close to that age when you can access your state pension and you are short, you can actually buy back some years to make sure that you do get a full state pension. So that's also something that I talk to clients about. So this is just giving you an example as if you were paying in £100 a month. So say, for example, you paid in £100 a month from the age of 25. When you came to retire at 67, oh, sorry, I've lost that slide, so I have to share that. So what it's showing you on that graph, which I'll come back to, I don't know if it's possible if I take off share screen and get back to that, or if it's going to take too long, but it was showing you that the later you leave it to contribute, it would mean that you're having to put in more. So effectively, you could be paying in £100 now, but if you were looking to retire, looking to start paying into your pension in your 50s, then you might be needing to put in more like £600 a month. So it just shows you that graph, how the table, how much you would need to be putting in and what that would give you in an income and a lump sum. So I will share the slides if you want after, so you can have a look at that. So running a business, if you were to pay, and when I say company, I mean limited company. If you were to pay £500 gross into a pension, you haven't had to pay any national insurance or income tax on that contribution. So effectively, you've got it into your own private name. And it would mean that you've almost extracted those profits. So the downside is you can't access it, and the age of that is changing in 2028 to age 57. It's currently 55. And then you can offset corporation tax also on that money that you've put into your pension. So corporation tax is increasing as well. So depending on what your profits are, it could be as much as 25% now. So you can offset your pension contribution as a business expense. It's a way of extracting profits out of your business and put them into your own private name. The downside is you can't access them till retirement. Now, those funds that you do pay into the pension, they will grow tax-free. And then also when you come to access later on when you're retiring, you can withdraw 25% of that pension tax-free, and the rest of the pension is taxed as earnings. So effectively, people don't tend to take the rest of their pot until they have fully retired and they don't have other income, so they can use up their personal allowance and they're not paying high levels of tax. There's nothing stopping you taking out the full pot as soon as you hit 57. It would just mean that you're going to pay a lot of tax. And we would always say it's best to separate that over tax years if possible. Now, when you're a sole trader, it works slightly differently. So you would pay in £500 as your net contribution, but the government would automatically add 20%. So effectively 625 will go into your pension. If you're in the higher rate, you can claim a further 125% off your tax bill. And an additional rate, taxpayer gets to reclaim a further 25%. But say if you're just a basic rate taxpayer, you get that 20% uplift, and the additional amounts that you can claim back if you're in higher rates or additional rates, you would have to do that through HMRC and just make sure they're aware of what you've paid in. So you have paid you would have had to pay your national insurance and your tax of 20% to take the money anyway, but you get that 20% back by putting it into the pension. So it's still a tax efficient thing to do, even if you're a sole trader. It's the same as if you had a limited company and you were paying into a pension, you can withdraw the 25% tax-free when you come to retirement, and it also grows tax-free. So I'm just going to come on to understanding your risk tolerance. So when a client comes to see me, we get them to fill in a questionnaire. So we go through their attitude to risk and their capacity for loss. So how adventurous do they want to be with their investments, but also the capacity for losses with that money. Say a client only had 10,000 that they were looking to invest, and that's all they had, then they might be their capacity for loss is much lower than someone, say, that has a pot of £1 million and they're only looking to invest 100,000 of that. They have more capacity for loss. So these are some of the typical questions that we might ask them in that risk profile. And the way we do that is we send out a link and then they can complete the questionnaire without my input. And they can have their time to think about their answers as well. But these are some of the questions that would come up. So questions that we ask as well, it's not all good positive questions. It might be, if your investment performed badly, would that loss impact your financial well-being, or would it have a detrimental impact on your standard of living? So that's where we're trying to see, how much is this investment going to affect you by asking those questions. So when it comes to investing, you need to think about what's the need. So why are you doing the investments? What's your capacity to be able to invest? And what is your willingness as well, with regards to investments? Risk tolerance depends on, so what I've got here is just a graph to show you that if you're willing to take adventurous risk, you've got expected higher returns in there, but you are taking more risk for those returns. And if you're looking to take a lower level of risk, then you're going to have a lower level of return. You're not going to see so much of your investments bouncing up and down, so they're going to be less volatile. With regards to the way that the portfolio would be built up, is that you would have more exposure in equities, which is your company shares, if you were taking a higher risk approach. And if you were taking a lower risk approach, you would have more in government bonds, corporate bonds, and areas that are deemed to be safer. And I'll come on to the different asset classes and where you invest. Alternative investments tends to be lending. So, but this would be how that might look as a breakdown for the different portfolios, depending on level of risk. So coming on to investments, there's 4 different asset classes. So you've got cash, which is your deposit-based savings. You've got equities, which is UK, overseas, emerging markets, your company shares. You've got gilts and bonds, and then also property. So we would always say with any portfolio, you should really try and diversify between all the different asset classes. We also say it's really important to have emergency savings. So if something goes wrong, you've got an amount of money that you can easily access. I always get asked, how much should that be? It's what you feel comfortable with. One client will come to me and say they're comfortable having 5,000 in emergencies. Another client will say I'm only comfortable having 100,000 in emergencies. So it's really what you feel comfortable with. I mean, the old rules were it would be something like 3 times monthly income. They might think that would be the right amount for them, but it does come down to, does your employer pay you if you are becoming ill? Have you got income protection in place? Have you got your liabilities covered with protection? So the amount of what you would have in emergencies really does come down to you as an individual and what you feel comfortable with. Also, have you compared the different interest rates? So I have got a slide that goes through the different rates that are currently available on the market. We've had many years of low interest rates, and at the moment we can take advantage of some better interest rates on your savings. And then, do you need instant access to those savings? That will make a difference on what you can get. Have you used up your cash ISA allowance? So you've got 20,000 cash ISA allowance available to you. So any growth that you do get in interest is not going to be taxable, because you only have £1,000 that you can earn in interest before you start paying tax. So we had a quick look just to see what was available on the market right now. And these were the rates that you could get. So say if you were happy to lock your money away for 12 months, you could get rates with, for example, the carbon skipped and were offering you 7%. But you might not be fortunate enough that you could lock that money away for 12 months, and you might need instant access to that money. So say, for example, you did, there's also an instant access account that skipped to offer you a rate of 5.5%. And then there's the limited access. So that's an account that you set up, but you have to give, it's a notice period that you have to give before you can access the money. So it's not instantly accessible, but you might have to wait a certain amount of weeks or days before you can draw the money back out again. So you can see the difference in rates you can get there. But I mean, if you can lock away some money for 12 months, you can see there's quite favourable rates in there on savings. But you also have the Financial Services Compensation Scheme, and that protects any individual with any one banking group up to 85,000 per person. So just make sure that none of the banks that you've put money with goes above 85,000 or they're linked. Because say if that bank went bust, then you know that the government, you would get that money back from that protection. So always keep an eye on that you don't go above that amount. So with regards to investments, another thing when people are starting out, I do say, have you considered premium bonds? And also, have you diversified the investments that you have got? So have you thought about different sectors, geographical? Have you done the different asset classes and looked at different companies? There's also other investments, so things to consider. You've got ISAs. We also set up company investments. I'll come on to more detail about that, and specialist investments that offer additional tax saving. There's also your typical investment accounts, and you've got bonds. There's lots of different types of ways of investing. It's looking at the right options for you, for your objectives. For example, is access important, or can the money be locked away for longer? That sort of thing. So with regards to cash, that would be any amount of money that you held with the bank, a building society, any money that you've got through national savings and investments. So cash provides security for an investor. The only thing is, it's not inflation proof. So if the interest on your cash is not enough to beat inflation, that money is actually being eroded. But it's always important to have an element of cash. Like everyone should have an emergency pot, really, their rainy day money. So the risk really with holding cash is, like I mentioned, is inflation. So in January that was 4%. I think that's just come down in February, and I've got a graph to show that. But also banks, there's a default risk there. So it's just making sure that you don't have more than 85,000 with them. Also, if you take out an account with them and you're like, amazing, I've got 7% interest, keep an eye on it, because that interest rate that you get might only be for an inductory period. So you might only have that interest rate for a year, for example, and then it drops down to almost nothing. So you should really be checking your savings accounts and moving around each year to get the best rates that are available at that time. So this just shows you what inflation has been. The current rate of inflation actually in February is 3.2%, so it has come down. But you can see if you weren't getting, 10% on your money that was sitting in cash, that money has been eroded. And really, inflation is, say, a pint of milk costs you £1 today, and it might cost you £2 tomorrow. The difference. So that means that your money is really getting you less than what it did before. So as a minimum, because inflation is 3.2, you need to at minimum be making sure you're getting that level of interest. Interest rates are coming down. So if you're going to do anything with your savings, I would say do it now and not wait for that. So then I just wanted to show you the difference between having a stocks and shares ISA versus a cash ISA. So you've got your green line, which is your adventurous portfolio. You've got a red line, we've got balance. Then you've got pink line, which is cautious. And then you've got your cash, which is the grey line. So you can see over that period, you're always better off being invested. You're going to see better returns. The only time that really dropped was during COVID. Now, during that time, obviously, I had clients that were nervous. Markets have come down. The worst thing to do would be taking your money out at that point, because you can see how the markets did bounce back and recover. So we always say, rules of investing is you want to invest when the markets are low and you want to take money out when the markets are up. The mistake a lot of people make is they take money out when the markets drop because they get nervous. But by having an advisor, that stops you from making those decisions. But you can see here with the cautious portfolio and the cash has actually performed quite well recently compared to what it had been, which was pretty much zero or low levels of interest for a long time. So it's definitely worthwhile checking that now, what levels of interest you could get. This is just a quick investment slide that shows, if you've invested the 30,000, what that would look like depending on the level of return that you got on there. So equity. So what are equities? They are investment into domestic overseas companies. You own part of that company. In return, you get your dividends. So the funds that you invest into might be made up of multiple different stocks. And I would say equities, they normally outperform any other asset class over the longer period. Compared to cash, they do outperform, but over a longer period, not short term. You've also got bonds and gilts. So this is where you're giving money to the government or a company for a certain amount of years. You know, at the start that you're lending this money to them, you're going to get a set amount of interest, and then you get your money back at the end of that period. So they're less volatile. They tend to be less riskier because it's a more, you know what you're getting with them. That we always say there should be an element of bonds in a portfolio, so that you should mix that really. Commercial property. So this would be things like, office buildings, shopping units, warehouses, industrial units. The majority of return comes from rental yield. I would say they're not very liquid, this asset class. So it's very hard if you've got your investments into commercial property, potentially to get your money back out of that. But there should be an element in your portfolio of property. So another question I get asked often is, why should I be investing in property, or should I be going into stocks and shares? Should I be investing my money this way or that way? So I always say it's good to have a combination of both if you can. So you might have your main residence that you live in, and that's kind of an investment, but also you might have separate to that stocks and shares. If you were then to go on to buy to let properties, for example, there's a lot of things you need to consider. Tax is a big one of them. So they've made a lot of tax changes. And I would suggest that if you're in the high rate, it's probably not worth it for you now to have a buy-to-let property, because the income that you earn from rental income just gets added to your income and taxed accordingly. So effectively, that is taxed at 40%. And there's not as much you can offset as what you could offset before. Growth is also a key factor. The income that you get from the rental, capital appreciation. So, property has gone up a lot in years. So, say, for example, your main residence, you might have seen that jump up as well. So, there's also the capital appreciation. There's also costs and charges. So to buy a property, you're going to be looking at legal costs, lender costs if you're taking out a mortgage. It's less liquid as well. It's harder to get out of. It's not like an ISA where you could just dip in and take some money out. You wouldn't be able to take some money out of your property that easily. You might have to borrow against the property to take money out of it, for example. If the property is not where you predominantly live and it is an investment property, you also have to factor in the capital gains tax as well. So this just explains a bit about why you would have a diversified investment and you wouldn't just go into one area. So what it's showing you is in 2023, the best performing was the US equity market. Interesting enough, last year, because of cash interest rates, the cash market was actually performing better than anything else. But typically, if you look back to 2019, cash was at the bottom because that's when you weren't getting anything for your money. And again, in 2016, it was at the bottom. Then you've got US equities were performing best again. And then 2020, it was Asia. And then back in 2018, we looked at global bonds were performing the best. And back in 2015, it was Japanese equities. So the reason for showing you this is it's really important that you have a diversified portfolio. So say, for example, if your portfolio was balanced, it's just a line through the middle of what you would expect. We would always suggest that you don't just go into one area because you never know which area is going to be performing well. And in the last couple of years, gilts have performed particularly bad. And so if you put all your money into gilts thinking, oh, that's government backed and that's completely safe, there was a massive drop last year with that, or back in 2022. So it's always key to have more of a diversified portfolio and using lots of different fund managers as well, not just sticking with your one fund manager. So looking at different fund managers and also a mixture of actively managed funds versus passive funds, which Vanguard do. So I'd always say look at different fund managers. When looking to invest, you need to think about the choice of where you're going. So it depends on your appetite of risk. making sure you've got diversification, as we talked about, that you're using the expertise of investment managers, you're actively looking at what's going on. Making it easy to invest can be through a financial advisor, making sure that you're being competitive on the charges that you're being charged for those investments. And also anyone that works with us, they do get regular information on what's going on in the markets and their portfolio. So you would want to have regular updates. So coming on to business investment. So say if you held money in a limited company, have you thought about if you're getting any return on that? Is the bank offering you an interest rate? Are you just drawing out the minimum income you need to cover your expenditure and leaving the rest in the business, because that's the most tax efficient way to do it? And have you accounted to make sure that you've got enough in that business account for tax liabilities and emergencies? So we do have an option where we can set up a company investment for you. So while the money's sitting in there, and the expected growth rate of that company investment is 6.4%. Minimum investment level is 10,000. And then the expected growth over this period you can see versus what you would have got in cash. So, if you'd set up this investment on that 10,000, you would have made 2,353 versus what you would have made in interest on your cash. That's if you had moved it into a better rate of interest account with your bank. There's also tax efficient investments. So there's your VCTs and your EISs. They're ways in which you can invest and get further tax relief. They tend to be for your individuals that are looking for that extra 30%, and they're looking to invest in areas that are I would say more startup, earlier stage companies, a bit more interesting. For the risk that you're taking and going into those investments, the government gives you the 30%, and on VCTs you also get tax-free dividends as well, which builds up an income. Typical yield is around 5-6%. So I'm coming on to inheritance tax and planning for incapacity, but I've got a feeling that I've almost run out of time, so I'm going to skip through this. But the key points are that, do you have a will? These are your allowances for that, so I'll send that through. Knowing your exemptions of what you can do in gifting. How I work with clients. So if you came to see me, we do the discovery call, we get you to complete a budget planner, then we have our initial 2-hour meeting, and then we do a presentation. You can meet with me in person or online, and then we do an annual review meeting to review everything, and that's kind of like the client journey. We don't charge anything for the initial or the presentation meeting. It's only once you've had all the recommendations that we charge a fee of what you're looking to invest. This was the quiz, but we're not going to have time to do the quiz. I'm just going to skip through. But a lot of these answers would have been in what I talked about. So I know we're running out of time. And so I just want to get to the last slide, which just explains my contact details and where we're based in the city. So thank you for your time. And I don't know if you had any questions.
Thank you, Rebecca. That was really interesting. I think Julia has dropped out again. So if anyone has got any questions, if you want to just unmute and ask away. Anybody? I had a question. When you say 30% income tax relief, what does that 30% actually mean? Like, how does that
Is
work?
that was on the specialist investments, was it? With the
Yeah,
EIS and the VCT?
but
Yeah.
the income tax relief was mentioned a few times with different percentages.
Okay. So if it was income tax relief on a pension, it would be, it depends on how that was going in. So if it was going in by a sole trader, for example, then you would get the uplift. So you would get a 20% added to your contribution into a pension. If you were in the higher or additional rate, you could also claim back a further amount from HMRC for that contribution you've made. If, for example, on a VCT or an EIS, that 30%, whatever you paid in, effectively you get 30% back of that as a tax reducer on your income that tax year.
Okay.
So it's done as a tax reducer. But I've had clients come to me and they've forgotten to put their pension contributions on their tax return, for example. And so if there's anything like that, you can obviously claim back tax relief from HMRC if you've not received it previously because you've forgotten to mention your contributions to your pension and so forth.
Brilliant, thank you. Anybody else with any other questions?
Yeah.
Go ahead, Emily.
Yeah. At the moment, I'm not paying anything into a pension. So where would your basic starting point be?
Okay,
So
so I would
should I be like just putting something into a savings account at least, or should I be putting something into something very basic to start with?
Yeah, so I often get asked this question of people where, they are self-employed or running a business and they don't know how much they should be putting in. If you were employed, 8% of your salary would be going into a pension. So really you should be aiming for 8% of your income to be going into a pension. Setting up a private pension is something that we can help you with. So if you wanted any advice on how to set up and what you should look at, we set that all up for you. We don't have minimum levels of investment because we have clients that we believe will grow with us and be with us for a long time. So we don't have any kind of minimum investment that you would need to have if you want to set something like that up. But I would say you should aim for 8% of your salary because if you were an employee, that's what you would be getting.
Okay, thank you.
May I ask a question? It might not be relevant for everyone, but oh, sorry, where's my microphone? Can everyone hear me?
Yeah.
Yeah, okay, yeah. I did pay into my pension in Spain, so that money is kind of there. Every now and again, my parents receive a letter saying you have now more money because of the way it's set up. But I wonder if you help with advice on how to put all this together, because I have no clue what's going to happen after Brexit with the money that's been put there and how that's going to work with the money that's been put here. Do I request separate pensions, or is there a way of just transferring that to my English pot? I don't know if you work with this.
So where are you going to be retiring? Here or there?
Who knows?
Okay.
Probably here. As much as I'd
Okay.
like to retire there with the sun, I think it's going to
If
be.
you are going to retire there, then it might be in your best interest to leave it there. But if you think that you're here and you're going to stay here all the way through retirement, then you could consider moving it over here. I don't help with moving international pensions into the UK, so you'd need someone that specialises in that area. What I do look at is any UK-based pensions. So once it has transferred over, I would then be able to help you with it. But it might not be in the best interest to transfer. It could be expensive. There could be tax consequences depending on what level, the amount of advisor charges you might end up paying to move it over. So in the UK, you've got UK pensions and you move to another country, you can still draw out your UK pensions from that country. So it's not always the best option to bring everything into the same country.
Okay, so it might be a good idea.
So it would be a good idea to speak to an advisor, maybe locally there, and also an accountant because of the tax implications of what taxes you pay in Spain versus the UK. Obviously, UK taxes are quite high. So there was a lot of considerations there before you start moving your pensions around from different countries, I would suggest. But the key question is where do you think you'll be when you do retire? And if there's a chance that you would be out in Spain, then you probably would want to keep your pension out there. Yeah.
Thank you.
How does the fee structure for financial planners work? Is it based on a percentage of the investment or the amount of money that you're willing to invest, or is there a minimum fee?
Okay, so all advisors charge differently. How we charge is we don't charge any fees for setting up protection. If we were to do a mortgage, we charge a fixed fee on application. If we were doing an investment, we charge a percentage of what you're looking to invest, and we don't have a minimum level of investments. So we have a menu of charges which got all our fees on there. So we would go through that with you in the first meeting, so you had an understanding. And when we do our analysis of consolidating pensions, for example, we try not to be more expensive than what you're already paying in charges. So we do a cost comparison as well as everything else. So we look at fund performance, where you've been invested. We look at any benefits those pensions are offering you and seeing if actually consolidation is the best thing to do or not. So I had a client the other day that had really favourable guaranteed annuity rates in his old pensions. And if you move that, you would lose that benefit. So it was in his best interest to retain those pensions where they were. without going to an advisor to look into your pensions,
Right.
you wouldn't be able to make that decision whether you should consolidate. As I said, we don't charge a minimum, and it tends to be a percentage. There's no fees for the first, second meeting. It's only once you've had all the recommendations you can decide if you want to work with us or not.
And is the menu of fees on your website?
I don't know if it is, but I can also send that through, so you've got a copy of that. And also,
That'd
it
be great.
depends on whether or not you want an annual review or a
Mhm.
biannual. Because if you want
Okay.
a review with me every other year, that brings down the charges. The reason for having an annual is because we do fund switching, we update
Yeah.
your Voyant report, which is your cash flow modelling, and we are quite proactive advisors in that, as in we're making sure you're using up your allowances and tweaking things around that it does improve. But if someone's tight on budget, then we charge a lower fee to meet them every other year.
Thank you.
We got
Don't know
any
if
other
there's any other
questions?
questions?
No. Okay, we are nearly at the end of the hour anyway. So thank you, Rebecca. That's been a really interesting session, and I'm
Yeah.
sure that QT would love to have you back again in the future to talk to us again.
Yeah.
I will sign off now on behalf of Julia. So thank you, Rebecca. Thank you, Christopher, Sharona, Magistra, Emily, Emma, Kaylee, Helen, and Julie, and Robin. So
Thank you.
thanks, Rebecca.
Thank you. I was going to say,
Bye.
the only thing I missed was about the estate planning, but that's probably more for your parents than you. So I thought that of anything, that's the only bit I skipped really, and then a bit of a quiz if I had time for it. So you did get the majority of the content
Brilliant.
from the slides. Yeah.
Brilliant. Thank you.
Thank you so
Thank you.
much. Thank
Bye.
Thank you, everybody.
Bye.
Thank you. Thank you, Emma. Thank you, Rebecca.